If you're thinking about buying your first home this year, congratulations. But you need to stop scrolling Zillow for just a second. There are 5 things you need to do before you ever step foot into a showing. And if you skip steps number 1 or 2, you could waste months of your time, or worse, fall in love with a house you can't actually buy. Hi guys, it's Jamie Hering of the Hering Homes team with Coldwell Banker Realty. I'm an Illinois and Wisconsin realtor with 11 years of experience, and I'm here to walk you through the first steps of buying your very first home, the ones that no one ever really clearly explains. Step 1, make sure you're actually financially ready. All right, before we talk about granite or quartz countertops and walk-in closets, we need to talk about real life. So number 1, you need a stable job. Your parents have probably been saying this to you, and most lenders want to see it. You need 2 years of consistent work history, pay stubs and W-2s, and ideally they should all be in the same field. If you switch jobs but stayed in the same industry, that's usually fine. If you're self-employed, the rules are a little different. You typically need 2 years of tax returns showing consistent income. Here's something I see a lot with small business owners. Small business owners will write off everything. Everything's an expense. The problem is lenders have to use the income you actually make. And if you don't make any income because you write everything off, you're not going to be able to afford a mortgage. So make sure you talk to your CPA early so you have a plan for when you want to buy a house. And if you just started a business 6 months ago, that doesn't mean you can't buy, but you're going to need a good strategy. Number 2, this sounds crazy, but you need to actually save money. Buying a home costs money, and it needs to actually be liquid in your bank account or accessible where you can get it. Gone are the days of true zero-down loans for most buyers, unless you qualify for something like a VA loan, which I'll talk about in a minute. So you need money for down payment, closing costs, earnest money, inspection, moving, and honestly, life after closing. You're gonna need new furniture, you're gonna want new curtains. So let's use a real life example. If you're buying a home for $400,000, you have a couple options. Option A, a 3% down conventional mortgage. 3% down equals $12,000, okay? Option B is an FHA loan, which for 3.5% down is the minimum payment, and that's $14,000. But here's what first-time buyers tend to forget. There's also closing costs, maybe 4 to 5%. So on a $400,000 purchase, that's another $8,000 to $16,000. Then you have to add earnest money, which is a good faith down payment. It's not required, but it's typical. A home inspection, that's maybe $600, $700. An appraisal, moving expenses, and possibly initial repairs. So realistically, I think that buyers need to have $20,000 to $30,000 accessible funds to hit the minimums. Now you can always put in a greater down payment and that will lower your monthly payment. So you don't always need that amount, and sometimes sellers can help with closing costs, but in a competitive market, you're less likely to get those. So you definitely need to budget and have money in your bank. So let me talk real quick about the 3 most common types of loans first-time buyers ask about. Conventional, FHA, and VA. So a conventional loan is the most common type of loan. You need a minimum down payment of 3%. Most people will pay around 20% if they can. So that's 20% of the purchase price. Typically, loans like this require a higher credit score. Usually 620 is the minimum, but better rates come with higher scores. There's no upfront mortgage insurance fee like other types of loans. And if you have private mortgage insurance, that'll fall off if you put down 20%, which is why most people try to do that. Once you reach 20% equity, you could also have that removed. Conventional loans are great if you have solid credit, stable income, and some money saved. And long term, they can be cheaper than FHA depending on your credit score. The next type of loan is an FHA loan, which stands for Federal Housing Administration. This loan is designed to really help first-time buyers or buyers with lower credit scores. So there's a minimum down payment required of 3.5%. There's more flexible credit requirements, and there's more flexible debt to income guidelines. So usually buyers that don't qualify for a conventional loan will then move to FHA. So here's the catch. FHA loans have something called mortgage insurance premium, MIP. That means there's an upfront mortgage insurance fee and monthly mortgage insurance. And in many cases, that mortgage insurance stays for the life of the loan unless you refinance. And a lot of times then buyers, FHA buyers, will refinance to a conventional loan to drop that. So FHA is a fantastic stepping stone, especially if your credit isn't perfect, but it's not always the cheapest long-term option. And the last type of loan are for my VA, for veterans and active military. This one is kind of special. It's one of the government-backed loans and it's very powerful. So you have 0% down payment. Now some of my VA loans do put down payment to lower their monthly payment, but required is 0% down payment, no monthly mortgage insurance, and the interest rates are pretty competitive. So VA loans are available and eligible to veterans, active duty service members, and some surviving spouses. This is one of the only true zero down options left. If you qualify, it's an incredible benefit. And we see it all the time because I'm located near Great Lakes Naval Base. So my job is to connect my buyers with trusted lenders, and they will tell you if you qualify for conventional, FHA, or VA. That way you're making a decision based on the numbers and not guessing what you think you can afford. So the right loan depends on many things: your credit score, your income, your job history, your debt, your savings, and your long-term goals. So that's why getting pre-approved early is so important. You want to know your best option before you start house shopping. If this is helpful so far, hit the like and subscribe button. I post a real estate video every single week. It's my life, and I want to make sure you are informed and aware of what's going on in our market. All right, so let's talk about the next step that people actually get excited about. You get the pre-approval letter. Okay, so there's a difference. It's not pre-qualified, that's not right. You want to get a pre-approval. This means you've been through desktop underwriting, and it's a big difference. A pre-qualified letter just means you told someone what you make and they're like, yeah, you're qualified for a $400,000 house. A pre-approval means it's been verified. You submitted to the online portal for this lender your pay stubs, your tax returns. They run a soft credit check or a hard credit check depending on the lender, and your bank statements. In today's market, you cannot shop without a pre-approval. If a $400,000 house gets multiple offers, sellers won't even look at yours without a strong letter attached. We need a pre-approval letter, because I will call that lender and make sure it's true and make sure they have verified you. And the second thing, just because you're pre-approved for $450,000, let's say, doesn't mean you have to spend that. Your comfort payment matters more than your max approval. So you have to run the numbers, include the property taxes, include homeowners insurance. Is there an HOA? Sometimes it's cheap, like $100 a year, and other times it's $500 a month. What your average utility costs are. In Illinois, property taxes especially will impact your monthly payment. And I will tell my buyers, you need to know your monthly number before you even find that house. Because what happens is that you fall in love with a house and then you overbid, and now that payment is not comfortable for you anymore. And property taxes will really impact. Like for me, my property taxes are probably more than my principal payment. So that's something to really consider. So you want to make sure you're comfortable, because these numbers like taxes or your homeowner's insurance will probably only tick up little by little every year. All right, step 3, you need to know where you want to live. This is where emotion kind of meets the logic of it. Price matters, but your lifestyle and where you want to live matters a lot too. So ask yourself, how far am I willing to commute? 30 minutes, an hour, 5 minutes? Do you want a walkable town? Do you care about train access? Are school districts important for resale? Are school districts important for the kids that you have or plan to have? Are you okay with higher taxes for a certain area? So let's use our $400,000 example. In one town, you might get a newer home, a larger lot, and lower taxes. In another town, you might get a smaller home, higher taxes, but amazing infrastructure in downtown and train access. So you need to decide what areas are most important for you. There's no right answer. I don't have to live there, you do. So I always tell my buyers, drive the neighborhood at night. Do you like what you see? Do you feel safe? You may want to call the police station, get numbers, visit on a Saturday, get coffee there. You're not just buying square footage, you're buying where you're going to raise your family or where you're going to retire. You're buying your everyday life. And if you don't want to drive 45 minutes every day to work, then don't look at a house that's 45 minutes away. Step 4, find the right realtor. Not all agents operate the same way. So you should ask your realtor, how many homes do you sell a year? Do you specialize in this area? How do you win in multiple offer situations? What happens if an appraisal comes in low? How do you protect me, the buyer, during inspection? Your first home is not the time to just use whoever. Never a good choice. We don't want anyone who's meh. You want a realtor who is just kick-ass, who's amazing, who educates you, who negotiates aggressively, protects your contract, knows the market deeply. This is what you want. I have an entire video talking about how to choose the right realtor, so watch that one next. Step 5, you need to start looking for a house. This is the fun part. This is where you can go out and search for homes, but you need to make sure you have stable income, you got a job, you have money in the bank, you have savings, you're pre-approved, you know where you want to look, and you have the right realtor. When you have all those things lined up, now the fun begins. So we'll set up a strategic MLS alert. We'll put you on Zenlist or our app. We tour with purpose. We tour the areas you want to see. We move fast when it's right. We stay disciplined when it's not. You don't need to be driving all over. You really need to focus and then go see those houses, because the goal isn't just to buy a house. The goal is to buy you the right first house, the one that fits you and your budget and where you want to live. If you're thinking of buying your first home this year, comment below first home and I can definitely help you walk you through that. And if you're not in Illinois or Wisconsin, I have realtor connections all over the country and I can find you a great buyer's agent. So make sure you watch my next video on how to choose the right realtor, because I dig deeper into that topic. And that'll save you lots of money down the road.